we are live. All right, so I was reading through YouTube comments, and you know, YouTube, overwhelming majority are people that love our videos. Mm-hmm. I personally love reading the haters. I do.
I get love a kick having haters.
Yeah, it's true. Yeah, if you don't have haters, you haven't really accomplished anything in life, right?
Haters. And
you know, some are just, they're sick of our ads because we do a lot of ads on YouTube. But sometimes you get that mortgage person. So I'll click on like their profile or whatnot and kind of do a deep dive to see what they're into. And they're typically people in the mortgage industry. And people in the mortgage industry, if they really understood what we do, they wouldn't hate us as much as they do.
They'd want to do business with us.
Absolutely, because we create, 70% of the people that contact us, we tell them that they should get a mortgage and maybe even refi. So they could actually get tons of leads from us.
They would get business.
Yeah, they would get lots of business if they actually understood this and took a minute to try to build a relationship with us and understand what we teach. They would get a lot of business from us. And the reason why we tell 70% of folks that they should not be doing what we teach is they're not ready for it. Mm-hmm. They're living paycheck to paycheck. If anything, this whole pandemic has exposed how many Americans are living paycheck to paycheck. And if you're living paycheck to paycheck, this isn't something that you should contemplate.
Nope.
However, if you're cash flow positive with decent credit and you're disciplined and you've kind of mastered your budget, a mortgage is one of the worst things for you. Mm-hmm. Now, when I say that, especially the mortgage guys are going to be like, oh my gosh, he's taking food off of our table. But think about how many Americans that actually represents. That's probably less than 10% of Americans.
Probably less than 10%.
And that's really who we're trying to market to. Yeah. And that's who we're trying to educate, is those folks who have mastered their budget, they're disciplined, they're educated, and they are, most importantly, cash flow positive. Because if you're not cash flow positive, this doesn't work, right? If you're paycheck to paycheck. But reading through some of the YouTube comments, I'll get folks that'll say, just pay extra on your mortgage.
Mm-hmm. A lot.
Yeah. So let's talk about that. The differences between paying extra on your mortgage versus utilizing a first lien position HELOC strategy. Mm-hmm. There are some drastic differences between the two. I'll start off with number one, liquidity. So even if you were paying extra on your mortgage and you were paying it down and you needed access to your equity, what are the only ways you're going to get access to your equity?
You're going to have to refinance. You have to go to the bank.
Which costs thousands of dollars.
That's right.
Right? So that's expensive. What's the other way?
You could go get a second lien HELOC.
True.
Pull some out.
And those are cheap. Mm-hmm. Yep. What's the downside of a second lien position HELOC?
It's more risk.
More risk. So when you hear folks talk about freezing home equity lines of credit, yeah, in 2008, 2009, you had freezes on home equity lines of credit. Not a plethora of them. It wasn't like nationwide where, I was reading one comment that says the government can freeze your line of credit. The government can't freeze your line of credit. That's up to the bank. That's not a government task. But in 2008, 2009, you had pockets, Atlanta, Memphis, Miami,
Arizona,
Vegas, Arizona. You had pockets that had the real estate meltdown. You had massive drops in real estate value. And if you're in second lien position, the bank is getting nervous because there's no guarantee that they're getting their money back. So they could freeze your line of credit. And freezing has different forms. But there's, back to the original point, what's the other way you can get access to your equity? Selling your house. That's not ideal.
No.
You don't want to have to.
Unless you really want to move.
Yeah, unless you want to move or something. You're not going to get access to that equity. So that's number one, my issue number one, because I want liquidity, because I want to be nimble, whether it be for opportunities or to survive. And we can talk about that in a little bit. But what are some other issues when comparing a HELOC? Again, not for everybody. So we're not saying this strategy is for everybody. We're talking about our client base, who this is for. You've got to have 660 plus credit score, 10+% equity in your home. You got to be cash flow positive. You got to be disciplined. You have to have mastered your budget. So it's not a high bar to set, but again, 90% of Americans don't meet those 5 criteria.
They'll be missing 1, 2, or 3.
Right.
Sometimes more.
And they're just not a good fit for this.
Yep.
But what are some of the other issues with paying extra on your mortgage versus this strategy?
So one of the big issues, and I think this may be the biggest issue, is in order for you to pay extra on your mortgage, you have to wait to find out how much you have left over once the month's over, right? So I put it this way. You've got your normal bills, your utilities, your gas, grocery, all that kind of stuff. And then you are someone that budgets well and you have left over after that. However, things come up in life. You're driving down the road and then all of a sudden you hit a pothole and your tire pops, right?
You have pockets that the real estate meltdown, you had massive drops.
And you're driving down the road and you hit that pothole and you need $300 to fix that tire and it's in your mortgage. How are you going to get it out, right?
Refinance or sell.
Right, or get some kind of small loan, or use a credit card.
Or a home equity line of credit.
Or a home equity
Why do we
line.
keep going back to that? Duh!
So my point is, you have to, and it's designed purposely this way, you have to make sure, okay, I've got a check coming in here in a couple of days. I'm good. I can now put this $300 towards it.
And every time you do this, it's picking it up on the audio. I got a habit of that. That's why I'm trying to sit farther away so I'm not pounding the table.
Bam! I just get a hammer.
I always do that when I'm talking. I pound the table. So back to your point, though. So you're paying extra into the mortgage, right? So you're bringing the principal down, which accelerates it, and you pay less interest. We're not disputing that. But when you need access to it, you don't have access to it, right? So again, we're kind of going back to liquidity. But another issue with paying extra on your mortgage versus a HELOC, a big disparity. A HELOC, how much of your income can you put into your HELOC?
All of it.
All of it. How much of your income can you put into a mortgage?
Just what you have left over after all bills are paid and you feel comfortable enough that, hey, I've got this money and I feel comfortable putting it in the mortgage.
Right.
That's it.
Yeah.
That's all.
So let's say somebody's making, we got a scenario pulled up on the screen that we'll share here in a little bit, but let's say somebody's got $12,000 coming in, right? Yeah. If they had, and we're using $12,000 coming in and $7,000 expenses outside of a mortgage, right? So if this person had a mortgage on $320,000, what was that, about $2,000? Okay, so they got $9,000 really going out, so they're $3,000 cash flow positive. So on a mortgage, they wouldn't put $12,000 in because they got $9,000 that they need access to pay. Well, they wouldn't have to pay the mortgage because they already met that payment, right? So now you got the other $7,000 that you have to pay for, groceries, eating out, vacation, all that stuff, savings, retirement, all that stuff. So they wouldn't have access to it. It would be stuck in the bank's treasure chest. It'd be stuck in the mortgage. However, with a HELOC, it's open in instead of a closed in loan. So you can put $12,000 in. That's why so many of our clients are successful. 90+% of our clients are successful because they have the confidence to put all of their income in. In a mortgage, they're not going to put all of their income in because it's stuck. When it's time to pay the $7,000 of expenses, they can't. They got to wait till next month's check. Now they're late on some bills, right? Yep. So that's issue number one, or number two. So number two, with a HELOC, you get 100% income utilization. With a mortgage, you cannot put 100% of your income into a mortgage. So therefore, you don't get 100% income utilization, right? So now you have to play what I call the payment strategy as opposed to a cash flow strategy. So that's number two. What's number three?
So I think number three, and this may not be where you're going, but I think this is an often overlooked, and I'm going to keep pounding the table today until the table breaks. Nonetheless, I think this is often an overlooked reason, and I think it's one of the biggest ones, and that is the psychological factor. Our clients, once they start doing this, are like, this is so easy. Why wasn't I doing this before? It automates it. They don't have to think about it. And, they say it's just so simple to do. It's much harder over an extended period of time, 1 year, 2 years, 5 years, to every single month sit there and play that waiting game. Okay, how much do I have left over this much? Okay, I'm going to put that in. Then when you do put it in, you're like, I can't get it back out. So subconsciously, you're thinking, it's helping me, but I can't get it. And, we always want access to as much as we can when it comes to liquidity. And when it's locked up in something, it makes it really, really hard for us consistently to put money towards a mortgage over years and years and years because we have that fear of loss. I can't easily get that money. And as previous loan officers, us two sitting right here at the table, we've heard it thousands of times that people say, yeah, well, I'm just going to pay extra to my mortgage. And then we refinance them 3 years later, they haven't paid a dime extra to that mortgage.
Correct.
And it's not because they don't have the cash flow. It's because they don't have the mindset to do it because they have that fear of loss. So I think that's one of the biggest things that's often overlooked. And people say, well, I'll just pay extra to my mortgage. And I ask, well, why aren't you doing it right now?
And when have you done that?
Yeah, and when have you done it? That's another good one. So that would be one of the...
And the typical answer is, well, I've never done it, but I could.
Right.
Okay, if you could, why haven't you? Because of that fear.
Yep.
And what makes you think that that's going to change moving forward? So another factor of a mortgage versus a HELOC is a HELOC, being simple interest, recasts every single day automatically for free, right? So in this scenario, somebody's putting $12,000 in on a $320,000 balance. The next month after their other charges, but $12,000 going in, and now you owe $308. So let's say you had a $320,000 balance. You put $12,000 of your income in. The next day, you have a balance of $308.
Correct.
So the HELOC automatically recasts every single day for free. So now you're paying interest on $308, not $320, and not what the original mortgage balance was. So a mortgage is an amortization schedule. So each month it's already planned out how much is going to go towards interest and how much is going to go towards principal, right? So when you make a payment, they've already allocated this much is going to us, this much is going to paying down your principal balance. With a home equity line of credit, in some home equity lines of credit, when you put the $12,000 in, the $12,000 goes to principal first, and then interest is calculated, right? As opposed to money coming in, it going to interest first, then principal, then recalculating a month later. That's a mortgage, right? Sometimes 6 months later. So that is also a big difference between a home equity line of credit and a mortgage, even if you were capable of saying, in this scenario, I think it was 72 months. In this scenario, $320,000, 3.5%, they're paying their home off in 72 months if they got $12,000 going in and $7,000 coming out, right? So 72 months on a HELOC, that's 100% income utilization. Could you get the same thing on a mortgage? The answer is pretty darn close. Not quite, but pretty darn close if you put 100% of your discretionary income towards the mortgage without fail every single month.
72 times.
72 times. And for 6 years, you cannot plan for a hiccup, because if there's a hiccup, the only way you're going to get access to that equity to get a new transmission or whatever it is that you need, guess what you got to do? You've got to refinance, pay thousands of dollars.
You got to borrow.
Or you got to go get a HELOC, which is what we're telling you to do now. Go ahead and do it now. So those are, now what do we count? Four distinct differences between a home equity line of credit and a mortgage. So when we get those haters on YouTube that say, well, just pay extra on your mortgage. I even saw one that was laughable, is biweekly. Well, I could just cut my payment in half and do biweekly and do the same thing. That is not even remotely close.
Not even close.
You take a $320,000 mortgage and take that payment and cut it in half and do biweekly, you might shave off 4 to 6 years. This is shaving off 24 years, assuming that was a 30-year mortgage.
Yep.
So that's that. Now let's also talk about the biggest thing, HELOCs being variable. We hear that all the time. And when folks hear variable, what do they think the direction of rates will go?
Always up.
Always up. They never talk about interest rates going down. What have rates done in the last 3 years?
They've gone down.
They have plummeted, right?
Okay.
So variable means up and down. So the rates have plummeted, right? Now, prior to 2016, rates, or 17, rates did go up, right? So they went up a little bit. 2006 on, what did they do? They plummeted.
2008 on.
2008. So 2008, they plummeted and then stayed there until
December of 2015.
December of 2015. So 7 years. They hit rock bottom and stayed there. Now, even though the Fed has come out and said that they plan on keeping interest rates low for the foreseeable future, and the definition of foreseeable future is different depending on who you talk to. My opinion, a year to 18 months minimum that they're going to keep rates low. A lot of people's opinion is longer than that because of all the other factors associated with increasing interest rates. But let's assume that you're right, that all HELOCs are variable, which they are not all variable. Some are fixed, some are hybrids. Let's assume that they're all variable.
That's an important piece, too, because some people don't realize that there are fixed-rate mortgages.
Yes.
Or, HELOCs out there. There are.
There's one bank that has a fixed rate on a HELOC lower than its variable.
Yep.
Which baffles me because we're both lenders for 20 years, and yeah, anytime we wanted a fixed rate, it was higher than the variable. But whatever. Even the banker at this bank is like, I don't get it, but whatever. So let's assume that this is a variable rate HELOC, and let's assume that it never goes down. Let's also assume that it never stays the same. Let's assume that the interest rate goes up 0.5 point every single year.
Year over year.
All right. So we've already got our baseline, $320,000 at 3.5%. We'll get it paid off in 72 months, which is 6 years, with when you have net monthly income of $12,000 coming in and $7,000 going out, and in a bank annual fee of $35, right? Because some of these HELOCs have an annual fee, some don't. All right. So that's 72 months. So that's our baseline. So what if interest rates went up 0.5 point every single year into perpetuity? What did it do to the graph?
Went up 2 months from
72
months to 74.
2 months. So every single year, your HELOC rate increases 0.5 point every single year. It changed your payoff by 2 months if income never increased in 6 years. If expenses never decreased in 6 years. So if you never get a raise, you don't go out and grind and get a side hustle and make more money, your payoff changed by 2 months. And that's not the typical client. Our typical client is like, okay, I've got access to equity. I'm going to go use that for investment opportunities, specifically cash flow assets like rental properties and things of that nature, things that produce more income on a monthly basis. Well, if you do that, guess what? You speed up the process.
Not to mention, we teach accelerating strategies, not just the normal cash flow strategy. We teach additional accelerating strategies as well to take your baseline HELOC and say, okay, you can apply this method and this method and speed it up even further. We're not going to go into those, but we do teach additional strategies to accelerate. So to give you an idea of where this ended up, you start at 3.5. That's the baseline interest rate we have in there. It's increasing by 0.5% year over year. That means at 74 months, you had 7 rate increases, right? Actually 6 rate increases at 72. Yep. So you had 6 rate.
You actually had 12.
No, well, on this.
Because typically the Fed will increase the rate by a quarter point each meeting. So let's assume that it's every other meeting they increase the interest rates by a quarter point. So you have 2 rate increases per year. And it could be all at once.
It could be 4 in a year. It could be you know 1 in a year. But so on the calculator, just for calculator purposes, it does it once a year. So my point was the end result for this calculator is your rate went all the way up to 6.5. You know, it started at 3.5, went up to 6.5, and you still only changed 2 months. And that's by doing absolutely nothing else.
All right, let's get more aggressive though, because again, haters. Back in 1981, back in my day, when I was 3, was I 3? I was 2. I was 2 in 1981. So anyways, rates skyrocketed. What if rates skyrocketed? So that's the other thing, right? What if rates skyrocket? And again, let's just have a quick history lesson. When is the last time that rates skyrocketed?
2005, but it wasn't even really a skyrocket.
No,
It was the most aggressive in the 2000s, but that's really it.
Yeah. So if we go back to that, a true skyrocket would have been 1981, the savings and loan crisis.
Early 90s, they moved up some too, but again, not a. If you're going to say skyrocket, yeah, I would say 80s.
So we are deathly afraid of variable rates.
By the way, that was 40 years ago. How does that make you feel?
40, yes, 40 years ago. 40 years ago, which now obviously says I'm 42. So we are deathly afraid of something that happened 40 years ago, right? But let's play that ball game. Let's say it goes up 1% every single year. Now we went from 72 months to 76 months of having the home paid off free and clear, right?
And no changes in income or anything else.
Nope.
Just the rate. So now you started at 3.5. You are now at 9.5.
9.5% on a HELOC rate.
Yep.
Right. Let's keep going.
Double it.
All right, double it?
Yep.
All right, let's go 2%. 81 months.
Yep. Went up 9 months.
So that is 6 years and 9 months.
So you're at 12% rate increase. So you're at 15.5.
15.5% HELOC rate, because that's what we were deathly afraid of. But yet, the math still shows that we're paying the home off in 81 months versus a 30-year term for these individuals, right? And they're still liquid and all that, right? Yep. So when there's time for opportunities, they've got access to their capital for opportunities. When there's times that they need to survive, they got access to their capital and times that they need to survive. So this is what folks are deathly afraid of, is rates skyrocketing. If you have a variable rate, not a fixed rate, or a hybrid HELOC, if your income never increases on that 7-year period, if your expenses never get better and you pay things off, that it doesn't adjust for that. And here's the argument to that. Why would expenses go down if inflation's going up? Cost of goods and services, right? Well, okay, yeah, because that would be, again, another hater comment. My expenses would not go down because inflation is 3%, so the cost of milk and gas and all that's going to go up, right? Cool. But wouldn't income also go up?
Right.
Yeah. I mean, heck, for crying out loud, we're trying to, minimum wage is $15 in some places. When I was a kid working at Champs Sporting Goods, it was $5.25. Right? I couldn't imagine being 16 years old making $15 an hour. I would have quit school. I'd be like, I'm rich. I'm going full time, Mom and Dad, at Champs Sporting Goods. So, what else should we talk about in relation to a mortgage versus a HELOC?
So one more thing on rates too. So we're using a 3.5% rate, and as rates increase, it doesn't mean the banks stick with what we're going to call prime rate. Let's just use prime rate as an example, because that's what's shifting upwards. That's what banks are pegging their HELOCs to. When rates back in 17, when prime rate was at 5.5, it didn't mean that every single bank had a 5.5% HELOC.
Right.
Many of them were significantly lower than that. So what I'm getting at is, even when rates go up, doesn't mean banks automatically across the board raise their rate up with the actual prime rate. Oftentimes, the rates stay relatively similar. It's just they're switching their margin around. So at 5.5, you're still getting rates close to what they are. It might be a little bit higher than what they are today, but still, lower than what actual prime is if it's much higher.
Idea for another podcast. Let's talk about bank profits and how banks make profits on the margin and arbitrage.
So that's one thing I wanted to point out about rates is, as prime shifts up, because that's what we're talking about here, as prime's moving up, it doesn't mean the bank's rates are going up, equivalently to how fast prime's moving. They'll shift their margins because remember, banks want business. And as rates actually go up on mortgages or all loans, as they go up, they start losing business because less people qualify. So in order to combat that, one of the easiest things for them to do with HELOCs, because they're portfolio loans, is all right, we're going to switch our margins around or offer promos and things like that to keep business coming in the door. So it almost, oftentimes, it's a bonus when rates are going up because banks get more competitive because they're trying to draw your business in.
Correct. All that to say, when it comes to a HELOC, there are two factors far more important than interest rate, right? And that's why people are scared of HELOCs, is they think that all of them are variable, and the variable means rates are going to skyrocket, and I'm not going to do that, right? It's a herd mentality. My neighbors have a mortgage, and my neighbor's neighbor has a mortgage, and my neighbor's neighbor, and my brother, and my mother, and all of them, they all have a mortgage. It's a herd mentality. So that must be the right thing to do.
And it's advertised everywhere.
It is. It is. So. We are being educated by the lenders to consume what they want us to consume. Why would they tell us any different? No, you shouldn't get this. You should go consume something else. That would be like us saying, hey, no, don't get a HELOC and don't get our strategy. You should stick with a mortgage. How long would we be in business?
How long?
Yeah, I'm just being transparent. But the thing is about transparency is this business has allowed us to speak the truth. Because now we can figure out a way to earn an income while speaking the truth. And that's why lenders and banks hate us. So it's a herd mentality to get a mortgage, and most people should get a mortgage. However, there are some people that just don't realize that what we're talking about today is much older than mortgages. The mortgage tool, debt tool, is a newer tool than a home equity line of credit.
Correct.
And so really all we're doing is going back to basics. So we'll wrap this up. Take care.